Imagine waking up tomorrow, scrolling on your phone, and finding out that a pixelated picture of a dog wearing a knitted beanie is suddenly worth more than the entire Ford Motor Company.
Right. I mean, it sounds completely absurd when you just say it out loud.
It really does. You would probably think the financial world had completely lost its mind, right? Like there was a glitch in the system somewhere.
Exactly. Because, we are so conditioned to think of finance in terms of serious things. Spreadsheets, boardrooms, quarterly earnings reports.
Very formal stuff, yeah.
Right. We expect billions of dollars to behave, well, seriously.
But see, the thing is, right now they aren't behaving seriously at all. In the world of crypto today, that kind of absurdity is just a Tuesday. We are seeing absolute fortunes made and lost over internet jokes.
It is actually quite fascinating from a psychological perspective.
It is, because if you are just scrolling through your social media feed at the end of a long day, you might see that funny dog in a hat, you smile, you like the post, and you keep scrolling.
Yeah, just an ordinary internet moment.
Right, but overnight, that exact same image turns into a massive global financial story. Suddenly, it is everywhere. Your neighbors are talking about it, teenagers are trading it, and the stakes get incredibly high.
Very high.
So welcome to another deep dive in our Crypto Beyond the Hype series. Today, our mission is to unpack this together and decode meme coins.
And let's get one thing straight right off the bat here.
Yes, absolutely. We are not here to give you investment advice. Keep your wallet strictly closed.
Right, please do.
We're just here to understand the mechanics of this phenomenon, like what do these coins actually reveal about human behavior? And how does an inside joke get a multi-billion-dollar price tag?
Looking at the bigger picture, see, this is the perfect lens through which to view modern digital behavior. Meme coins sit right at this wild collision point of internet culture, human emotion, and decentralized technology.
It is a total collision, yeah.
It is. If you really want to understand the crypto space beyond the tech jargon, beyond the hype, you have to look at these coins because they show you the raw mechanics of how hype itself is actually manufactured.
Let's get right into those mechanics then. I mean, we all know what a meme is. Anyone who has used social media in the last decade knows about viral jokes.
Oh, definitely.
But there is a massive leap between a funny picture that makes me laugh on my phone and, a financial asset that people are actively trading. How does that transition actually happen?
Well, to understand the shift, you have to look at how traditional cryptocurrencies started, right? If you look at Bitcoin or Ethereum, they were launched with deeply complex technical missions.
Right, solving big problems.
Exactly. They had these long, dense white papers explaining cryptographic security, decentralized ledgers, network scaling. They got their early value from developers solving very difficult engineering problems.
Okay, so very technical foundations.
Yes. But meme coins, they bypass all of that entirely. They do not pretend to solve a complex engineering problem at all. They are fundamentally the financialization of attention.
The financialization of attention. Wow, that is a heavy phrase.
It is, yeah.
Let's break that down for the listener. What does that actually mean in practice? It kind of sounds like a viral street food trend or a fashion fad where the hype itself is the actual recipe.
That is a perfect analogy, actually. The hype is the recipe. In the modern digital economy, attention is no longer just a marketing tool that you use to sell a separate product. Attention is the product.
Right, the focus itself has value.
Exactly. It is the underlying asset. If enough eyeballs are focused on that dog in a hat, the collective focus essentially mints value. They use these recognizable symbols, heavy irony, and cultural moments to capture human focus, and then they just attach a digital token to that focus.
Okay, I hear what you are saying about attention. And I mean, if millions of people look at a viral video, that video obviously has power. But I have to push back a bit here.
Sure, go ahead.
I understand wanting to belong to an online community. I understand making friends and sharing a laugh. But people are pouring their life savings, their rent money, into a token with a cartoon dog on it.
Yeah, they are.
You cannot honestly tell me that is just about finding a digital tribe. Isn't this just raw, unadulterated greed, like a modern-day get-rich-quick scheme disguised as a joke?
See, you are hitting on the most uncomfortable truth of this entire space right there. Greed is absolutely a massive part of the engine. I would never deny that.
It has to be, right.
The allure of turning $50 into $50,000 overnight, that is the primary hook. But And this is a crucial, but if it were only raw, cynical greed, these coins wouldn't sustain themselves for more than a few hours.
Really? Why not?
Because the greed brings people in, but the community identity is what creates the floor.
Wait, what do you mean by the floor?
In financial terms, the floor is what stops everyone from simply cashing out at the very first sign of profit. When people buy into one of these coins, they don't just hold it quietly.
Right, they get very loud about it.
Exactly. They join massive online groups. They change their profile pictures to the dog in the hat. They create a shared language. They actually start calling themselves an army.
I've seen that, yeah. The Doge army, things like that.
Yes. And they convince each other to have what they call diamond hands, meaning they refuse to sell even when the price drops heavily.
So it becomes personal.
Highly personal. That crowd psychology, that collective belief, it mixes with the financial incentive. The attention builds more attention, and that collective caring actually creates a bizarre form of durability.
Okay, so the community creates this bubble of belief, but we still need to talk about the actual reality of the markets here, because the swings we see are violent.
Oh, incredibly violent.
We're talking about heart-stopping volatility. One day, the dog in the hat is going to the moon, the internet is celebrating, and then, the very next Tuesday, people get bored, someone launches a coin with a cat in a shoe, and the dog coin crashes 80%.
Yeah, that happens all the time.
Mechanically, why does it swing so violently like that?
To understand the volatility, we have to look under the hood at how these coins are actually minted today compared to even just a few years ago.
Okay, what changed?
Well, in the early days of crypto, launching a coin required serious coding knowledge. You had to actually build infrastructure. Today, that barrier to entry is completely gone.
Completely gone.
Yes. Anyone, anywhere can use automated smart contracts to launch a brand new token in about 5 minutes.
Wait, 5 minutes? Literally, we are not exaggerating here for effect.
Literally 5 minutes. You give the token a name, you upload the picture of the dog, you set the total supply, you click a few buttons on a platform, and your coin is live and tradable globally.
That is terrifyingly easy.
It is. But because it is so incredibly easy to create, these coins launch with very little actual capital backing them. In finance, we call this a shallow liquidity pool.
A shallow liquidity pool. Let's make sure we really understand this because it feels like the key to the whole thing.
Think of liquidity as the pool of real money sitting there to facilitate trades. When you buy shares of a massive company, say Apple, there are billions and billions of dollars in that pool.
Right, so if Apple is a massive ocean and I take a rock, let's say $1 million trade, and I throw that rock into the ocean, nothing really happens. The water barely ripples. The ocean is simply too deep.
Exactly. But a new meme coin is not an ocean. It is a teacup.
The teacup?
Yes, because it was created in 5 minutes by a random person. The pool of real money backing it might only be a few $1,000s. If you drop that exact same rock, even just a $10,000 trade into a teacup, all the water violently splashes out.
Wow.
The pool is so shallow that a single person buying or selling, or even just a viral tweet from an influencer, creates a massive tidal wave.
That teacup analogy is frightening when you really think about it, because what happens when the price shoots up 1,000% in an hour because of that tiny teacup effect?
The FOMO kicks in.
Exactly. It triggers everyone's fear of missing out. Every day people see those numbers, they feel a sense of panic that they are missing the boat, and they just rush in to buy.
And that emotional urgency is exactly where the profound danger lies. The system is entirely dependent on continuous new attention.
Because there is no real business behind it.
Right. There's no cash flow, no real-world utility. The value is tied 100% to the mood of social media. If the mood changes or the crowd gets distracted by the next shiny object, the teacup empties just as fast as it filled.
Leaving a lot of people stranded.
Exactly. The fall is severe, and the people who bought in last, driven by FOMO, are the ones left holding completely worthless tokens.
Which brings us to the packaging of all this, right? The very thing that draws people in, the humor, the memes, the cute animals, is exactly what makes it so treacherous.
It lowers the guard.
It really does. It feels a bit like walking into a casino that has been completely decorated like a children's playground.
Oh, that is a great way to put it.
The games look cute, the branding is bright and friendly, everyone is laughing, but you are still betting your actual rent money at the blackjack table, and the house odds are brutal.
See, that humor actively disguises the reality. When you see playful branding and a community communicating entirely in heavy irony and internet slang, it frames the entire experience as a cultural game.
Right, it doesn't feel like high-risk finance.
Exactly. It disguises the reality that real money is on the line. Traditional assets might be boring, but that boredom serves a very important purpose. It encourages rational analysis.
And meme coins replace that with emotion.
Pure emotional momentum. You should never, ever confuse friendly branding with lower risk. In this space, it usually means the exact opposite.
Okay, so given everything we've just discussed, the shallow liquidity, the violent volatility, the disguised casino aspect, why do some very smart, observant people still defend this space?
That is the big question.
Because we've all seen tech founders, venture capitalists, and prominent voices talking about meme coins as if they represent a genuine financial revolution. To truly understand this beyond the hype, we have to look impartially at both sides. What is the actual defense here?
The defense is rooted in a philosophical view of modern finance. From their perspective, traditional finance is heavily gatekept.
What do you mean by gatekept?
Well, to get into the best early-stage investments, you usually need to be a wealthy, accredited investor. You need brokers. You need to navigate massive regulatory walls.
Right, everyday people are locked out.
Exactly. Even the early serious crypto projects have largely been taken over by massive Wall Street firms. So the defense argues that meme coins are a rebellion against those distant formal elites.
Ah, I see. It's the internet native crowd saying, we don't need your institutions to tell us what has value. We will decide for ourselves just by gathering together.
Precisely.
It reminds me a bit of the GameStop stock phenomenon a few years ago. Retail investors banding together to outmaneuver the hedge funds.
The parallel to GameStop is very, very strong. It is all about the democratization of attention. They argue that meme coins allow everyday internet communities to create and capture value without asking permission from a bank.
The community builds the brand, and the community reaps the rewards.
That is the argument, yes.
But we also have to look at the other side of that argument. The criticism is just as loud, and based on what we've discussed about teacups and casinos, it is incredibly valid.
The criticism points out the dark side of that democratization. Yes, you are bypassing the gatekeepers, but you are also bypassing all the consumer protections.
Right. There are no safety nets.
None. Critics argue that this environment heavily encourages impulsive speculation. It rewards short-term, coordinated hype over any kind of deep, sustainable understanding.
And it pulls everyday people in.
Exactly. It pulls inexperienced people, people who might not understand liquidity pools at all, into highly volatile situations where they are essentially gambling against very sophisticated insiders.
So we are left with this fascinating and somewhat dangerous duality. On one hand, we are witnessing a genuine cultural rebellion, right? A shift in how communities financialize their own attention.
Yes.
But on the other hand, we're watching everyday people get pulled into a volatile casino where the house edge is hidden behind a funny picture of a dog. How do we even reconcile this?
I think mature thinking requires holding both of those truths at once.
Holding both truths. I like that.
You can absolutely respect the massive cultural power of social momentum. You can acknowledge that decentralized communities create real financial gravity. But you can do all of that without surrendering your own judgment or your own wallet to it.
So you can observe without participating blindly.
Exactly. What this whole phenomenon truly reveals is that human beings are not rational, calculating machines. We are driven by stories, by the deep need for belonging, and by the powerful desire not to be left out.
We are emotional creatures trying to navigate a highly digitized financial world.
We really are.
Which brings us to the most important part of our deep dive today. Let's bring this down to a practical mindset for the person listening right now.
Let's do it.
If someone is watching this all unfold on their social media feeds, how should they navigate this space? How do they observe the modern digital economy without getting burned?
The very first step, the absolute baseline, is to stop treating meme coins like stable, long-term, traditional investments.
They're completely different animals.
Literally and figuratively. If you apply the rules of a traditional retirement account, or even the rules of holding Bitcoin, to a newly launched meme coin, you will miscalculate the risk entirely.
Right, because you were swimming in a teacup, not an ocean.
Exactly. The second step is learning to actively separate your curiosity from your impulsiveness.
That is tough to do on the internet.
It is, but it is crucial. It is perfectly fine to be curious. It is natural to want to look at a massive trend and try to understand it. But you have to recognize that urgency is a manufactured emotion in these fast-moving markets.
Manufactured how?
The platforms and the communities are designed to make you feel panicked, to make you feel like if you don't click buy in the next 10 seconds, you will miss out on generational wealth. You must consciously push back against that rushing feeling.
But how do you actually do that in the moment? When your feed is screaming at you and you see screenshots of people making thousands of dollars, the FOMO is overwhelming. How do you hit the brakes?
You hit the brakes by asking better questions.
Better questions, like what?
Instead of looking at a chart going up and asking, will the price go higher today? You need to step back. Ask yourself, why do people actually care about this specific coin?
Get to the root of the attention.
Right. Ask, is this attention organic, driven by a real community? Or is it being artificially pushed by influencers who were paid to post about it?
That is a very important distinction.
And perhaps the most crucial question of all, given our teacup analogy, what happens to this price when the attention inevitably moves on to the next trend?
I love that approach. You don't have to jump onto a moving train just because everyone hanging out the windows is cheering and waving at you.
Exactly. Let the train pass.
Asking those critical questions shifts you from a state of passive excitement into a state of active awareness. You become an observer of the mechanics rather than a victim of the hype.
And if we pull back even further, beyond just crypto, meme coins are ultimately a masterclass in modern internet culture.
How so?
What we are seeing is the blending of categories that used to be completely separate. Money, personal identity, digital entertainment, and social media, they are no longer distinct things.
They are all mixed together now.
They've all merged into one continuous, high-speed stream. Understanding how a meme coin works helps you understand the modern internet itself, even if you never buy a single fraction of a cryptocurrency.
That is a brilliant way to frame it. Let's quickly recap the journey we have taken today because we've covered a lot of ground here.
We definitely have.
We started by redefining what a meme coin actually is. It is not just a joke, it is the financialization of attention. We explored the deep psychological need for belonging that drives these communities, and we acknowledged that raw greed also fuels the engine.
We also looked under the hood at the mechanics. We discussed how smart contracts allow anyone to launch a token in 5 minutes, creating those incredibly shallow liquidity pools, the teacups that make the price swings so violent.
We confronted the reality that friendly, playful branding acts as a disguise, dangerously lowering our guard when real money is on the line.
Yes.
And we looked impartially at both sides of the philosophical debate. The idea that this democratizes financial access versus the reality that it fuels impulsive, high-risk speculation.
Which brings us to a rather profound realization.
Oh, why is that?
Think about it. If collective attention is the exact mechanism that takes a pixelated dog and gives it a multi-million-dollar market cap, it really forces you to look at your own habits.
In what way?
In today's heavily connected, hyper-fast digital world, is your everyday attention actually the most valuable currency you own?
Wow. That is the thought we want to leave you with today. Who really controls your attention, and what kind of value are they minting out of it while you just scroll?
Something to think about.
Truly. If you enjoyed cutting through the noise today and found this breakdown helpful, please do subscribe to the series. Like this deep dive and share it with a friend or a family member who is trying to make sense of the crypto space in a simple, practical way.
And we always love hearing your thoughts.
Yes, please drop a comment with the next topic you want us to explore together. Because the more clearly you understand the hidden mechanics between hype, community, and risk, the more confidently you can navigate the world of crypto beyond the hype.
Stay curious, but stay cautious.
Absolutely. So the next time you are sitting on your couch and you see a funny picture of a cat in a shoe or a dog in a hat, just remember, there is an entire world of complex psychology, shallow liquidity pools, and immense community energy sitting right beneath that punchline. Thanks for joining us, and we will catch you on the next deep dive.